Your money feels safe. But what if it's built on bad debt you were never meant to see? This is how the financial system quietly turns risk into so-called safe investments. Wall Street calls it securitization, a system designed to hide bad debt in plain sight. It's the same mechanism that fueled the 2008 financial crisis. And it never went away. It evolved. Today, it lives inside corporate debt and collateralized loan obligations, or CLOs, protected by AAA ratings and hidden in the shadow banking system. This isn't abstract. It affects retirement funds, jobs, and wealth inequality. Why financial crises aren't accidents. They're systemic risk by design. In this video, you'll see how Wall Street really works and why ignoring it is a choice.
What if I told you that the very same banks responsible for the 2008 financial crisis have perfected a way to turn toxic debt into safe investments? And they're selling these financial time bombs to retirees, pension funds, and even governments right now. It sounds conspiratorial, maybe even absurd, but what you're about to discover is not only real, it's completely legal, operating openly inside the modern financial system. Here's the paradox. How do you take defaulted loans, delinquent mortgages, and risky debt, and transform them into AAEA-rated securities that look as safe as government bonds? This isn't advanced math or secret formulas hidden from the public. The truth is far more disturbing. The system is shockingly simple, brutally efficient, and deliberately designed to hide risk in plain sight. Think of it like this. Imagine 1,000 spoiled sandwiches, some barely edible, others rotten to the core. Instead of throwing them away, you grind them all together, repackage the mix in elegant wrappers, slap on a premium label, and sell it as gourmet food. Absurd? Criminal? In finance, this process has a respectable name, securitization, and it's celebrated as innovation. You'd think the devastation of 2008 would have put an end to this. Trillions lost, millions of lives upended, entire economies shaken. So why are the same practices still alive today, just wearing new names and new acronyms? The answer exposes a deeply uncomfortable truth about power, regulation, and who the system is really built to protect. In this video, you're going to see how subprime mortgages, risky corporate loans, maxed-out credit cards, and distressed debt are quietly transformed into investment-grade products bought by institutions worth billions. We'll break down the 3 key players behind this machine, show who actually profits from the risk, and reveal why ordinary people always absorb the damage. You'll also see why Wall Street and organized crime rely on eerily similar strategies. Complex structures to hide liability, captured regulators, privatized profits, and losses dumped onto society. And here's the most alarming part. This machine never stopped. While politicians promised reform and the media declared the crisis over, securitization didn't disappear. It evolved. Today, the industry is larger than it was before 2008, and the warning signs experts are raising look hauntingly familiar to those who were paying attention before the last collapse. This isn't history. This isn't abstract. This is your retirement, your pension, your savings, and the stability of the economy you depend on. These products are everywhere, and when they fail, the consequences spread to everyone except the people who engineered them. Because once you understand how this works, you'll never look at your bank statement or your so-called safe investments the same way again. Now let me show you exactly how this perfect crime is pulled off. The transformation starts with what the industry calls origination. Banks and lenders issue thousands of individual loans, mortgages, credit cards, auto loans, corporate debt. Some of these loans are solid. Many others are not. A significant portion are what Wall Street politely labels as subprime or non-performing, which is just a sanitized way of saying they're already shaky or very likely to fail. On a bank's balance sheet, these loans are dead weight. They tie up capital, attract regulatory scrutiny, and threaten profits if defaults rise. So instead of keeping that risk, the banks move to the next step, pooling. Thousands of these loans, good, bad, and ugly, are bundled together into one massive financial package. Then comes the critical move. The pool is sliced into layers known as tranches. The top tranche gets paid first and is marketed as extremely safe, often stamped with AAA ratings. The middle tranches absorb some losses and offer higher yields. The bottom tranche, the equity layer, takes the first hit when borrowers stop paying and is openly dangerous. Here's where the illusion is created. Because losses are expected to hit the bottom first, rating agencies claim that the top 70 or 80% of this structure is protected, safe, stable, investment grade. Never mind that every single layer is ultimately built from risky loans. This entire system rests on mathematical models that assume defaults won't happen all at once. It's financial alchemy, turning lead into gold on paper, while the underlying reality never actually changes. Now, before we go further, let me pause for just a moment, not for a sales pitch, but for something more important. If this explanation is clicking for you, if you're starting to see how simple and unsettling this machinery really is, I want you to do one thing. Use the comments. What worries you most about the financial system right now? Have you felt this risk personally, through your savings, your job, or your family? Drop a comment. That conversation matters, and here's why. Engagement isn't about supporting a channel, it's about resisting obscurity. Algorithms decide whether this kind of information spreads or dies quietly. Commenting, liking, participating is how ideas like this escape the bubble of complexity they're designed to hide in. It's how clarity competes with silence. Because now comes the most disturbing part of this entire process. You understand how bad debt is created, bundled, and sliced into tranches. The next question is unavoidable and deeply uncomfortable. Who is buying this stuff and why do they believe it's safe? The buyers are the missing link that makes this entire system work. Because no matter how complex or elegant a financial product looks on paper, it's worthless if no one is willing to buy it. And that's where the real transformation happens. Where genuinely risky debt is reborn as premium investments and sold to institutions that manage other people's lives, not just other people's money. We're talking about pension funds, insurance companies, university endowments, sovereign wealth funds, municipal retirement systems, trillions of dollars. These institutions are legally required to be conservative. They're not supposed to gamble. Their mandate is safety, stability, preservation. So here's the question that should immediately bother you. How do you convince the most risk-averse investors on earth to buy securities built from loans that were shaky from day one? The answer is securitization. And when you strip away the jargon, it's one of the most sophisticated confidence games ever normalized by modern finance. It doesn't deny risk. It rearranges it, mathematically dilutes it, and then claims it no longer matters. And once you truly understand this process, you start seeing the same structure everywhere, then and now. It always begins with raw material, thousands of individual loans. Mortgages are the famous example, but the same logic applies to auto loans, credit cards, student debt, corporate loans, any stream of future payments. Every loan carries uncertainty. People lose jobs, get sick, face emergencies. Some borrowers are solid, many are not. Subprime isn't a moral judgment, it's a statistical one. Higher probability of failure. If a bank held one subprime loan, the risk would be obvious. Price it wrong, and you lose money. But banks don't want obvious risk on their books, so they pool thousands of loans together into a special entity, a legal shell designed for one purpose, to hold debt and spit out securities. At this point, it almost sounds reasonable. Diversification is real. One default doesn't kill a pool of 1,000 loans. And that's the hook. Because this is where risk management quietly turns into risk concealment. The pool doesn't issue one security. It issues layers, tranches. Think of a waterfall. Money flows from the top down. Senior tranches get paid first and are labeled ultra-safe. Mezzanine tranches come next and offer higher yields. At the bottom sits the equity tranche, the shock absorber, the first to be wiped out when borrowers stop paying. Translated into plain language, losses are deliberately concentrated at the bottom, so the top can pretend they're protected. Now comes the sleight of hand. Credit rating agencies step in and bless the senior tranches with AAA ratings, the same rating given to government bonds. On paper, these securities now look as safe as the foundation of the global financial system itself. And here's the emotional disconnect you need to feel. Nothing about the underlying loans changed. Only the packaging did. So how do rating agencies justify this? With models, assumptions, beautiful spreadsheets that assume defaults are random, housing prices don't fall nationally, and economic stress never hits everyone at once. In calm times, these assumptions seem reasonable. In real crises, they are catastrophic. And why would rating agencies stretch these assumptions? Because they're paid by the bank selling the product. If they say no, the deal goes to a competitor who says yes. Everyone in the chain understands this. Everyone benefits from looking the other way. Now follow the cascade. Pension fund managers see 8AA ratings. They see yields slightly higher than government bonds. They see compliance checkboxes all ticked. They don't dig into thousands of individual loans because the system is designed to make that practically impossible. Complexity becomes camouflage. And here's the part that should make you angry. No one in this chain is exposed to long-term failure, except the final holder. The broker got paid, the bank got fees, the rating agency got paid. Risk was sold, not eliminated. That's moral hazard. Decisions without consequences. So what happens when reality breaks the assumptions? When defaults aren't random? When housing prices fall everywhere? When unemployment rises across the board? When interest rates reset at the same time? The waterfall doesn't save anyone. It just dictates the order of collapse. Bottom tranches vanish, then mezzanine. Then even the safe AAA tranches start bleeding. And because these securities are everywhere, pensions, insurers, banks, the losses spread outward, freezing credit, killing jobs, destroying savings. Translated one last time. When this system fails, nobody in the chain pays, except society. And here's the most uncomfortable truth of all. This isn't just history. The structure never disappeared. It evolved. Different assets, new acronyms, same logic, same incentives, same blindness. If this is clicking for you, if you're starting to see how disturbingly elegant and fragile this system really is, drop a comment and write, "I see it now." Now we need to go one level deeper. Because understanding how securitization works is important, but it's not enough. What really matters is identifying who built this system, who enabled it, who profited from it, and who deliberately looked the other way while it expanded. This wasn't an accident. It wasn't a market failure. It was a structure, designed, executed, and maintained by real institutions. And it only worked because 3 key players acted in coordination. This isn't speculation. This is documented in official investigations, court records, and internal communications that later became public. Accomplice number 1. The banks, the architects. Let's start with the banks, because without them, none of this exists. Goldman Sachs, Morgan Stanley, Lehman Brothers, Bear Stearns, Merrill Lynch, Citigroup, Bank of America. These weren't fringe players. These were the most powerful and respected institutions in global finance. And they absolutely knew what they were doing. Their role was brutally efficient. They either originated risky loans themselves or bought them from mortgage brokers, and evidence from official investigations shows they actively encouraged lower lending standards. Volume mattered more than quality. Worse loans meant higher interest rates, and higher interest rates meant securities that could be sold to investors chasing yield. This isn't opinion. Internal emails released during congressional hearings show bank employees openly describing certain products as junk or garbage while continuing to sell them to clients. In some cases, the same banks were simultaneously betting against the very securities they were marketing as safe. That's not a metaphor. That's on the record. They packaged these loans into mortgage-backed securities and CDOs, collecting fees at every stage: origination, structuring, underwriting, distribution, servicing, and critically, they didn't keep the risk. The entire model was originate, package, sell, move on. Once the risk left their balance sheet, so did responsibility. Translated plainly, the people who created the danger didn't suffer the consequences when it exploded. Accomplice number 2, the rating agencies, the gatekeepers. But the banks couldn't pull this off alone. Pension funds and insurance companies can't just buy anything. They need ratings. That's where Moody's, Standard & Poor's, and Fitch come in. These agencies act as gatekeepers to trillions of dollars in institutional capital. Their job is supposed to be independent risk assessment. Here's the documented problem. They're paid by the banks issuing the securities, not by the investors relying on the ratings. This issuer pays model isn't controversial. It's acknowledged, studied, and heavily criticized in official reports. After the crisis, lawsuits and investigations uncovered internal emails where rating analysts openly joked about approving deals they didn't believe in. They admitted their models were flawed. They admitted pressure from management to deliver favorable ratings or lose business to competitors. In some cases, agencies even advised banks on how to structure deals specifically to achieve higher ratings. Let that sink in. They assumed housing prices would never fall nationwide. They assumed defaults would be random. They assumed the loan data provided by banks was accurate. These assumptions weren't hidden. They were written directly into the models. And when reality shattered those assumptions, the ratings collapsed almost instantly. At the peak of the bubble, rating agencies were issuing A/A ratings to complex mortgage products faster than they were rating traditional corporate bonds. Some of those A/A-rated securities defaulted within months, something that should be virtually impossible under their own definition of risk. This isn't hindsight, it's documented failure. Accomplice number 3, the regulators, the ones who looked away. And now the most uncomfortable chapter, the regulators, the SEC, the Federal Reserve, the OCC, the OTS, state and federal agencies whose explicit job was to prevent exactly this kind of behavior. They had the authority. They saw the warning signs. They received complaints about predatory lending. They watched leverage explode. They observed housing prices detach from economic reality. And again, they chose inaction. Why? Multiple official reports point to the same causes: ideological belief in self-regulating markets, regulatory capture, and the revolving door between Wall Street and Washington. Many regulators came from the financial industry and expected to return to it. Aggressive enforcement doesn't align well with future seven-figure salaries. This wasn't partisan. Both political parties embraced deregulation. Both trusted innovation. Both accepted the idea that sophisticated markets didn't require strict oversight. In some cases, federal regulators actively blocked states from enforcing consumer protection laws, arguing that nationally chartered banks should be shielded from local scrutiny. That decision is documented, the full structure. So here's the entire system, stripped of complexity. Banks created and sold toxic products while betting against them. Rating agencies labeled those products as safe to collect fees. Regulators stood aside while the system inflated. Each actor depended on the others. Each had powerful incentives to keep going. And each avoided real accountability when it collapsed. This isn't a theory. It's a structure. It's documented. And it explains why the system didn't truly change. Because the people who benefited the most were never truly punished. And next, we need to look at what happened after the collapse, when the house of cards finally fell, and what that response reveals about power, accountability, and who this system is really designed to protect. If you're connecting these dots, write this in the comments. The game was rigged. Now we go even deeper into what happens when this entire apparatus of deception finally collides with reality. Understanding how securitization works in theory is one thing. Seeing what happens when it breaks is something else entirely. Because this is no longer abstract finance. This is about real people, real homes, real families, and a system that revealed its true priorities the moment the truth could no longer be hidden. In early 2007, something began to crack in the mortgage market, something the banks, rating agencies, and regulators had all insisted was impossible. People started defaulting on their home loans at levels not seen in generations. And this wasn't limited to a few struggling cities or regions. It was nationwide, millions of borrowers, all at once. Adjustable rate mortgages that had been sold with low teaser payments suddenly reset to much higher rates families simply could not afford. At the same time, housing prices, which had supposedly only one direction to go, began to fall. And this is the moment everything breaks, because the entire securitization model rested on one fragile assumption. Even if borrowers couldn't pay, The house could always be sold for more than the loan. But once prices fall, foreclosure no longer recovers value. It creates losses. And when losses appear, those beautifully engineered tranches, supposedly sliced by risk with mathematical precision, instantly become meaningless. The technical term is a liquidity crisis turning into a solvency crisis. But in human terms, a liquidity crisis means nobody wants what you're selling, even if it supposedly has value. A solvency crisis means it's actually worthless, and you're broke. Mortgage-backed securities and CDOs worth hundreds of billions of dollars suddenly had no buyers at any price. No one could tell what they were worth. Rating agencies that had stamped these products as OAA began downgrading them in panic, sometimes multiple levels in a single day, quietly admitting they never truly understood them in the first place. Those downgrades triggered a chain reaction. Assets were marked down. Capital vanished. Margin calls followed. Forced selling pushed prices even lower, which caused more downgrades. A self-feeding collapse that moved faster than anyone could stop. And this is where most people think the system corrected itself. They think this was the wake-up call. But it wasn't. In March 2008, Bear Stearns, one of Wall Street's oldest institutions, collapsed and was sold off for a fraction of its value in what was essentially a fire sale. In September, Lehman Brothers, a firm that had survived the Civil War, both World Wars, and the Great Depression, filed for bankruptcy, the largest in American history. Merrill Lynch was absorbed in a desperate weekend deal. AIG, after insuring massive amounts of toxic securities without setting aside real reserves, required a government bailout exceeding $180 billion because its failure would have detonated the entire system. This wasn't an orderly correction. This was panic. Markets froze, trust evaporated, and for a brief moment there was a very real fear that the global financial system might simply stop working. But here's the part that matters most. Who actually paid the price? The executives and traders who created these products, who sold them while knowing how fragile they were, who collected millions in bonuses during the boom years. Almost none faced serious consequences. Some lost their jobs, but many walked away with golden parachutes worth tens of millions. Prison sentences? Nearly non-existent. And those that did occur focused on small-scale fraud, not the systemic deception carried out by the largest banks. The institutions themselves were rescued, roughly $700 billion through TARP, plus trillions more through Federal Reserve programs, guarantees, and emergency lending. The decision was simple. These banks were too big to fail. Their collapse would hurt the economy too much, so taxpayers would absorb the damage instead. Meanwhile, ordinary people paid the real cost. More than 8 million Americans lost their jobs. Unemployment doubled. Millions of families lost their homes. Not because they were reckless, but because they lost jobs in a collapse they didn't create, or because they were sold mortgages designed to fail, or because their homes dropped so far underwater that escape became the only option. Household wealth fell by nearly $13 trillion, wiping out savings, retirements, and decades of work. Homeownership, once a symbol of middle-class stability, collapsed and still hasn't fully recovered. Picture this on a human level. A family buys a home in 2006, stretching their budget because everyone says real estate always goes up. A year later, the house is worth far less than the mortgage. The job disappears when the housing market collapses. They can't refinance. They can't sell. The foreclosure wipes out everything. Their credit is destroyed. Their kids change schools. Their future is reset. Meanwhile, the CEO whose bank fueled this disaster retires with a 9-figure compensation package, and no one questions it. The total economic damage is staggering. Between $10 and $20 trillion in lost output. An entire year of American productivity, gone. Not because of a natural disaster, not because of war, but because a small group of decision-makers chased short-term fees and bonuses inside institutions protected from failure. And here's the most disturbing part of all. The system didn't shrink. It concentrated. The biggest banks became even bigger. Bear Stearns disappeared into J.P. Morgan, Merrill Lynch into Bank of America, Wachovia into Wells Fargo. The crisis didn't eliminate too big to fail. It reinforced it. These institutions now borrow more cheaply simply because the market assumes the government will rescue them again. This is the true legacy of the collapse. A system where risk is privatized in good times and socialized in bad ones. Where incentives reward volume, not quality. Where enforcement is weak, accountability is rare, and the consequences flow downward. And the worst part? This model didn't die in 2008. It evolved. In the next block, you're going to see how this exact same playbook was adapted, repackaged, and redeployed across modern finance, right up to today. And once you see it, you'll never look at the system the same way again. If you're starting to recognize these patterns and realize this is still happening, right, still happening today, in the comments. Now I need to show you something that completely changes how you should see the financial system right now. Because if you think everything I've shown so far is just history, a painful lesson that was learned and corrected, you're missing what's happening in plain sight. The uncomfortable truth, the one that should genuinely worry anyone paying attention, is this. The core machinery that caused the 2008 collapse was never dismantled. It was rebranded, repackaged, and quietly redeployed at an even larger scale. And this time, if it breaks, it won't look like 2008. It will be worse. Before, the collateral was houses. Now the collateral is entire companies. Let me introduce you to CLOs, collateralized loan obligations. And if that name sounds disturbingly familiar, it should. Structurally, CLOs are almost identical to CDOs. The only real difference is the underlying asset. Instead of residential mortgages, CLOs bundle leveraged corporate loans, loans made to companies that are already deeply in debt. The same playbook, just aimed at a different target. The process is hauntingly familiar. Risky loans are pooled together. They're sliced into tranches with different priorities. Rating agencies step in and declare the senior tranches investment grade, even though they're built on junk-rated debt. Then they're sold to investors desperate for yield in a world where safe returns barely exist. And the scale of this market is staggering. Before 2008, the CLO market hovered around $300 billion. Today, it's well over $1 trillion. Let that sink in. After watching this exact model implode the global economy, the industry doubled down, only bigger, and it gets worse. A massive share of these leveraged loans are what's known as covenant light. That's industry language for loans stripped of meaningful protections. Traditional corporate loans had covenants, rules that limited how much debt a company could take on or required certain financial benchmarks. Those rules acted as early warning systems. Covenant-light loans remove those guardrails entirely. Companies can pile on more debt, pay dividends to private equity owners, or weaken their balance sheets, with almost no consequences for lenders. Today, more than 80% of new leveraged loans are covenant-light. Before the last crisis, that number was under 30%. We didn't learn caution. We learned complacency. And here's the part that should make you deeply uncomfortable. The institutions running this machine are largely the same ones that drove the mortgage securitization boom. JP Morgan, Citigroup, Bank of America. The same banks that collapsed or required massive bailouts are now at the center of the CLO market. The same rating agencies, Moody's, S&P, Fitch, are once again stamping fragile structures with reassuring labels. And after 2008, regulators carved out specific exemptions that left CLOs largely untouched, creating a loophole so large the industry drove a $1 trillion market straight through it. But this story doesn't stop with CLOs. The securitization engine has spread everywhere. Student loans have been bundled and sold, while total student debt has surged past $1.7 trillion. Auto loans, especially subprime auto loans, have been securitized into massive asset-backed markets. Credit card debt, personal loans from fintech platforms, even solar panel financing, different labels, same structure, same incentives, same fragility, and those incentives never changed. Loan originators get paid for volume, not quality. Banks earn fees for packaging and selling, not for long-term performance. Rating agencies are paid by the issuers they rate. Investors chase yield, often without fully understanding the risks, because safer options offer almost nothing. Everyone gets paid up front. No one is truly responsible when it goes wrong. This is why the pattern repeats so perfectly. Not because the system forgot what happened, but because it remembers and doesn't care. The people making decisions know that if things spiral out of control, the damage will be socialized again. Reports from the Federal Reserve, the Bank for International Settlements, and the IMF have warned repeatedly about leveraged lending, weakening protections, and systemic risk. But warnings don't change behavior. Incentives do. And the incentives are exactly the same. What makes this moment especially dangerous is how deeply embedded these products are. CLOs aren't sitting in isolated hedge funds. They're held by insurance companies backing pensions, by mutual funds inside retirement accounts, by banks using them as collateral for more borrowing. Just like mortgage-backed securities before 2008, they're woven into the core of the financial system. The pricing models assume that corporate defaults won't spike all at once, that failures will be isolated, that risk is diversified, but those assumptions collapse in a recession. When economic stress hits, companies fail together, recoveries plunge, and suddenly, losses appear in tranches that were supposed to be untouchable. What we've seen over the past 15 years isn't reform, it's evolution. The same predatory architecture, adapted to new markets, exploiting new vulnerabilities. The beast didn't die in 2008. It was wounded, rescued with public money, and allowed to mutate, now protected by the dangerous belief that it can't happen again. The truth is, we're sitting on a powder keg of leveraged debt, securitized, obscured, generously rated, sold to yield-hungry investors, built on the same broken incentive structure that already collapsed the system once. No one can predict exactly when it will unravel. These systems can look stable for years, until suddenly they're not. Until one shock hits, and everything breaks at once. And that's why understanding this isn't optional anymore. Because this isn't history repeating itself. It's history continuing. If you're seeing how the same structure keeps resurfacing under new names, write "same playbook, different assets" in the comments. Now we need to go one level deeper. Because once you truly understand why this keeps happening, something clicks. This stops being a story about mistakes, bad luck, or a few greedy individuals. You start to see that this system isn't malfunctioning at all. It's operating exactly as designed. And that design guarantees that crises aren't accidents. They're features. What looks like reckless behavior from the outside is actually perfectly rational behavior on the inside. And that distinction is everything. Here's the core of the problem. In most areas of life, decisions come with consequences. If you run a restaurant poorly, it fails and you lose your money. If you're a negligent doctor, you lose your license and face legal consequences. But modern finance created something radically different, a system where profits are private, but losses are socialized. When bets pay off, insiders keep the rewards. When bets explode, the damage is pushed onto investors, workers, retirees, and taxpayers. That incentive structure is toxic. It makes extreme risk not just attractive, but logical. Think about the mortgage broker who got paid for every subprime loan, whether it ever got repaid or not. Think about the investment banker whose bonus was tied to how many CDOs they sold, not whether those CDOs survived. Think about hedge fund managers collecting fees year after year on CLO portfolios, then walking away untouched when everything collapsed. The downside barely exists for them. Fines, when they happen, are paid by institutions, not individuals, and are often a fraction of the profits made. At scale, wrongdoing isn't punished, it's rewarded, and this connects directly to regulatory capture. Wall Street doesn't just influence regulation, it helps write it. Hundreds of millions of dollars flow into lobbying and political donations every year, buying access, exemptions, and enforcement that looks tough on paper, but weak in practice. The revolving door between Wall Street and regulators is so normalized that people barely question it anymore. Executives move from banks to agencies like the SEC or Treasury, help shape policy, then return to the private sector and profit from the very rules they helped design. This isn't hidden, it's openly how the system works. That's how too big to fail quietly evolved into something even darker, too big to jail. When institutions become large enough, Prosecuting executives is seen as a threat to financial stability. And once that logic takes hold, size becomes a shield. The more damage you can cause, the more protected you become from consequences. Justice flips upside down. The worst crimes receive the least punishment. Step back, and the resemblance to organized crime becomes impossible to ignore. Complex structures to hide risk, networks of mutual protection, corrupted oversight, profits laundered through legitimate-looking channels. The difference is that traditional crime operates outside the law. Financial crime rewrites the law and staffs enforcement with insiders. It's cleaner, quieter, and far more profitable. And this is where the mindset shift happens. These crises aren't freak events. They're the predictable outcome of a system built on misaligned incentives. Waiting for insiders to reform it voluntarily will never work. Real change only happens when maintaining the system becomes more costly than fixing it. And that pressure only comes from public understanding and demand. So what can you actually do? Here's the simple mental checklist. First, know where your money really is. If you have retirement accounts, mutual funds, or pensions, don't assume they're safe. Ask what you actually own. Ask about exposure to leveraged loans, securitized products, private equity structures. If answers are vague or evasive, that's your warning sign. Second, demand transparency, not trust. Complexity is a weapon. If something can't be explained clearly, that's often intentional. Understanding breaks the information asymmetry this system relies on. Third, support real structural reform, not cosmetic fixes. History already showed what works. After the Great Depression, separating risk-taking from everyday banking stabilized the system for decades. Undoing that separation led directly to modern crises. Reform isn't about left or right, it's about incentives. And finally, share awareness. These schemes only work when people don't realize what's happening. The moment patterns become visible, power shifts. Awareness creates accountability. Accountability creates pressure. Pressure creates change. This isn't about panic. It's about preparation. The next crisis may have different names and different assets at the center, but the structure will be the same. And the people who see it coming won't be the ones blindsided. And in the final part, I'm going to show you the single most important way to make sure you're not the next victim of this system. If this explanation connected the dots for you, right now I see it in the comments. If you made it all the way to this point, pause for a second, because that already says something important about you. This wasn't easy content. It wasn't comfortable. It required you to question things most people never stop to examine. And that takes real intellectual courage. That matters, because nothing ever changes when people refuse to look directly at uncomfortable truths. Change only starts when awareness breaks through denial. And now that you've seen the pattern, understand this clearly. You can't unsee it. From this point on, ignoring how this system works is a choice. Once you recognize the structure, the incentives, and the repetition, pretending it's random or accidental is no longer an option. If this kind of deep structural analysis into how the financial system actually works is valuable to you, hit subscribe, because this is exactly what we do here. We don't stay on the surface. We break down the hidden mechanisms shaping your money, your job, and your future. We connect dots powerful institutions would rather keep disconnected. And we have honest conversations about how the system truly functions versus the story we're told. From how private equity quietly hollowed out entire industries, to why commercial real estate is becoming the next pressure point, to how central bank policy bakes inequality directly into the economy. This is just the beginning of understanding how the game is really played. If this explanation fully clicked for you, leave "Now I see it" in the comments. Not just for the algorithm, though it does help, but because this channel is about building a community of people who refuse to stay blind to how power and money actually operate. I read every comment, and I want to know this landed. And if this video was worth your time, tap the like button. That single action tells me something important, that going deep instead of staying comfortable is what you're here for, and it helps shape what comes next on this channel. Now pay attention, because this part matters. There's a video on screen right now that takes everything we just uncovered and turns it into practical awareness. It shows you how to spot these warning signs in real time, the specific signals that appear before another crisis hits. This isn't optional knowledge anymore. Understanding the system is step one. Knowing how to read what's happening right now. That's how you avoid being the next casualty. Remember this, and don't forget it. The system doesn't break by accident, and once you understand the game, you never play it the same way again.